Good morning. It's around about 9:30 European time, UK time on Thursday. We just wanted to do another flash update because obviously asset prices are moving incredibly quickly at the moment. As we speak, the S&P futures pre-US market are flirting with that limit down, lockdown level once more that we saw a couple of days ago, so around about 5% down. We're seeing new lows in things like European banks, the Eurozone banks. So some big moves going on there. But what I also wanted to look at is that there's some other things that happened outside of the equity market which I think were really interesting and quite worrying. Firstly, you probably heard in the news yesterday that corporate credit lines are now being drawn down. So these corporates, these are the people who are buying the market through the buybacks. Well, if they're drawing down their emergency credit lines, they're clearly no longer doing buybacks. So that buyback is out of the market for now. But the fact that they're drawing down their credit lines is an indication of a desperate dash for cash. We saw LQD, this is the investment grade ETF, have a massive drawdown yesterday, and it massively underperformed the Treasury futures. So this is the 10-year US Treasury futures. It's been following it for the last 2 or 3 years, but yesterday the drawdown was significantly worse than the pullback that we saw in the bond market. Now that move in the bond market itself was quite interesting. Normally when we've seen risk-off environments, the bonds have gone higher, bond futures go higher, yields going lower. Yesterday we saw yields going higher, bond futures selling off. It's an indication that even in this environment, a bit like what we saw with gold a few days ago, when people need cash, when they need margin, they'll sell their winners. And it looked like yesterday there was evidence that some people are starting to sell the bond market as well as equities in order to offset some of these losses. And I think the big problem here is that who were the buyers? Well, we mentioned the corporates, they're out of the market. Smart beta and the passives, they're also probably sellers here. With volatility at these sorts of levels, that would be well through the trigger point where these guys are net sellers of equities rather than buyers of equities. It may be that these guys, the pension funds who are both buying equities and bonds, are in some cases selling both. And also you've got to remember that passive funds, they don't carry cash. Active managers carried cash, that's a buffer, they buy the dips. Passive funds don't. Passive and smart beta are a bigger part of the market, particularly in the US, than active. So that buffer from the active managers is no longer there at the moment. And then vol, we've talked about this before. This is the volatility of volatility. It's been getting higher, and I think the trapdoor today might see vol go higher because, again, these smart beta funds who've been selling volatility, well, they might now have to start covering some of those positions as well. So it's not just the VIX that's been going up, that's been hitting these high levels, but vol is the one to really watch for real distress in the market. And also another worrying sign is that despite the pullback over the last 2 weeks, the shares outstanding in the triple Qs, this is the ETF on the Nasdaq, until 2 days ago, this had made a 5-year high. So people were going longer into this sell-off. The actual move in the Nasdaq itself has actually been relatively good compared to the rest of the market because people were buying it. Well, yesterday we started to see liquidations once more in the Qs from this 5-year high. But when we look at the Nasdaq itself, as of this morning, including the Nasdaq futures, it's still above the lows of October 2019. There's still profits to be had in that index. It's so far not got below the level where the Fed started to pump the market last year, October and September, with that excessive repo. So I think there could be some liquidations to come in the Qs. I think that's one of the key levels and key areas to look at as well. Now, in terms of how to deal with this market, markets have been getting oversold. Now, people like to look at the mean reversion ideas, but when you get a market in panic, markets go oversold and then they get more oversold. So looking for mean reversion is not often a good idea. And an example of that is in 2008, I worked at Morgan Stanley and they had a fantastic European research strategy team. And their model was one which gave buying opportunities to say the market is massively oversold. In 2008, around September, that model went into a significant new low, something that had never been seen in 20 years. And the view that they took at the time was not, this is now a great buying opportunity, but that markets were now broken, which obviously they were. The point being here is that yes, markets are oversold. Use that as a guideline, but don't expect it necessarily to mean revert because things can get more and more oversold. So how to play in terms of what asset classes? We've been talking about in FX, safe havens versus commodity and EM. I don't think of the dollar just as the dollar, think of it in these sort of separate buckets. It's been successful to be long yen, it's been successful to be long euro, short the commodity currencies and EM. That's still continuing, but interestingly today, the DXY is relatively unchanged. Yen is stronger, but the euro is sort of flat. So maybe some of that repatriation has now ended and people are now starting to worry about Europe. So we'll keep an eye on the euro as the currency which may be moving away from safe haven into something else. In terms of other currencies, I think the Korean won was also another one where I expected it to be a lot weaker. It's been a little bit both ways because that's been a credit to nation. It looks like they've been taking money back. But the Korean won has been weakening. I think that will break the very big channel that we've talked about before. Copper, it's still only just breaking its big level. It's massively outperformed oil for obvious reasons. But I still think there's some juice to be had in copper to the downside and therefore basic resource stocks. And if I look at the oil energy stocks, they've obviously massively underperformed. And in Europe, they've gone to a ratio versus the broad market that we've never seen before. Now, I'm not saying catch that falling knife, but again, this morning, in a market that's down 5-6%, the energy sector, SXEP, has slightly outperformed. And in the recessions of 2000 and 2008, energy stocks actually outperformed the market. I'm not saying we do that from here because I think oil's got some more downside, but it's to bear in mind, people still need crude oil even in a recession. And I think the final point here to make is that last week, 2 weeks ago, I talked about being long China versus other markets. And some people say, well, why would you be long China? But that's because China and some Central and Eastern Asia dealt with this early. China has actually outperformed the S&P as of this morning by 10% over the last few days because obviously it's gone down less. Now, it may be that the government's having a better job of intervening there than they are in the West, but these are the sort of things we should look for. The ones that moved first and had the downside already, they're the ones that could be finding their feet first. I'm not saying China goes up, it'll probably go down, but maybe not as fast as elsewhere. I think the overall way to think about framing this is that governments are putting their economies into an induced coma to deal with coronavirus. They're effectively saying we're going to have to shut things down to halt the march of the coronavirus. So they're going to induce a recession in order to stop this halt. I think that's the way to think about this. So if this is a recession that we're going to see because they're inducing a coma, then we've clearly got a lot more downside in equities. You normally get that 40%. If it's a depression, 80%. But we've had 20-25% so far. But think about it in those terms. Italy has gone into a complete lockdown. It'll probably happen in the rest of Europe. I'm here in the UK. Feels it's going that way here. Maybe the US is a couple of weeks behind. But induced comas on the economy, that's what we're looking at here. And that means there is yet more downside to be had unless we get an absolutely enormous package, fiscal package and a monetary package. But I think that the fiscal package is to deal with the aftermath of the induced coma that we're about to see. Thanks.